This podcast is brought to you by Customplan Financial Advisors, Inc., an independent insurance managing general agency in Canada. Financialpodcast.ca was developed with one goal in mind: to educate Canadians on important topics that affect their financial well-being and make it readily available to all. We welcome you to plug in and learn with us. If you have questions, please email us at contact@financialpodcast.ca.
Hello, and welcome to the Financial Podcast. My name is Gary Poyer. The Financial Podcast is brought to you by Customplan Financial Advisors, an award-winning managing general agency that provides support and resources to the independent financial advisor. Please visit customplanfinancial.com to see all the resources that are available to you as the independent financial advisor. Today, we'll be focusing our discussion on the tax implications of when a taxpayer passes away. And we're very fortunate to have with us Michelle Coleman of MNP in Edmonton. Welcome, Michelle.
Thank you.
Michelle, please tell us a little bit about yourself and your background.
Certainly. I work out of our Edmonton office, as you mentioned. I'm a CPA and a TEP, which is a trust and estate practitioner as well. So I work in our Canadian tax group, but I've chosen to specialize further in trust and estate planning and helping people to work through their goals both now and for their eventual estate so that we can hopefully get them to where they want to be and also hopefully decrease taxes as much as possible.
Wow, the job sounds like it's very interesting.
It is.
Well, and it sounds like you're the perfect person to have on our podcast today. Michelle, way back in 1716, Christopher Bullock said, "'Tis impossible to be sure of anything except death and taxes." And it seems that nothing has changed in the past 300 years, and it's probably a safe bet that nothing will change in the next 300 years. Do you see any changes happening in the next 300 years?
They may change how it's taxed, but I don't think the tax is going away anytime soon.
Yeah, I don't think so either. Okay, death and taxes, a topic that all financial advisors and personal representatives or executors should know quite a bit about. And Michelle, after a person has passed away, the personal representative has to file a tax return with the Canada Revenue Agency on behalf of the deceased. On behalf of the deceased. What is this tax return called? What period of time does it cover? And by when does the tax return have to be filed with CRA?
So the individual who is looking after the person's estate first also has to look at whether or not tax filings have been missed from before. So they do have a responsibility to catch up on any past filings that there are, whether or not those are personal filings or if they're a sole proprietor, maybe some GST filings. So make sure you're caught up to that point in time. But then specifically to your question, that last tax return that someone files for an individual under the social insurance number is called a final or a terminal personal tax return. And that tax return covers the period from January 1st of that year that they passed away up until the date of death. And that return is due somewhat dependent on when someone passed away. So that tax return, if you passed away early in the year, is due April 30th, the same time a regular tax return would be due. If they were self-employed, it would be due on June 15th. If someone passes away late in the year, from November 1st to December 31st, given that it may be more difficult to gather information because there's a lot that you need to deal with, that deadline is deferred to 6 months after the date of death. If you don't have the information gathered by that point in time, you should still attempt to file a return, even if it's an estimate, to avoid having late filing penalties.
Okay, so once the terminal tax return is filed, there's still one more tax return that has to be filed for the estate. Is that correct?
There is. So when the individual passes away, they are now no longer a taxpayer under their social insurance number, for a lack of a better way to put it. Mm-hmm. So everything that they own that hasn't passed outside of their estate to individuals as direct beneficiaries or property that's jointly owned, that goes into their estate, which is a separate person for tax purposes, has a separate tax account number, and tax returns would need to be filed, excuse me, for that estate as well.
Okay. So as a personal representative or executor or executrix, there's quite a bit to do from a tax perspective
There
to wind
is.
up the estate.
And so whenever possible, as soon as they feel ready to start to get some advice, they should reach out, interview some advisors and get people they're comfortable with on their team and get an idea of what the timelines and deadlines are so that they know what they're working against, so they don't have that stress of, oh gosh, that's due next week, I didn't realize, so that they're able to work their way through in a less stressful, if it's possible, way.
Yeah. Imagine being an executor or a personal rep, stressful enough as it is. And then when you're dealing with Canada Revenue Agency, it becomes even more stressful.
It can be, and sometimes people have an assumption that there's not a requirement to file that estate tax return until they've dealt with the estate, but that's not correct. It is still due within specific timeframes, whether or not you've been able to move through with the estate or not. And so the maximum deadline for that first estate year end is the anniversary of the year of death. And then the return will be due 90 days within that. Okay. So even if you haven't been able to move forward with the estate, you may still have a filing requirement before that.
Okay. Oh, that's good to know. I think, to me, it sounds like filing the terminal return is more complicated than a regular tax return because there's the regular income of the person has earned up to the date of death, the registered investments, and then the non-registered or the capital investments as well. So besides the regular employment income or business income, what other forms of income might the executor need to take into account?
So in many ways, that terminal or final tax return is the same as a regular tax return. It's just a shorter year. Okay. So you would also have to pick up if there was rental income or farming income or investment income, all of those kinds of things from January 1st to the year of death. The remainder of the year, that income belongs to the estate instead, or the beneficiary if there was a direct beneficiary. But in addition to those things, that final tax return is quite often someone's largest tax return in their lifetime. And it's possible where we maybe have people who've sold businesses and things or property and they've had a big tax return. But often for the average Canadian, I think that final tax return is one of the highest ones, because we'll look at registered accounts and how those need to be treated on passing. Those registered accounts are no longer registered accounts once you're no longer the owner of them, once you've passed away. There are some changes that need to be dealt with, and you're deemed to have disposed of everything that you own as well. So you had mentioned the capital asset impact. And so people don't always think of the fact that there's a couple of significant things that we need to look at reporting on that final terminal tax return: the disposition of everything that you own and dealing with your registered investments, in addition to what you would normally put on your return. And not only income, but deductions as well, picking up childcare, medical, those donations, things that will help reduce those taxes also. Right.
Yeah. You mentioned about registered investments. Canadians going back to the mid-1950s have been encouraged to save for retirement through a registered retirement savings plan and then to convert the RRSP to retirement income fund. How does CRA treat the RSP or the RRIF for tax purposes when somebody passes away?
So it starts out as a little alarming, and then we maybe have some ways to deal with it. So that first sort of general rule is that account is treated as though it's withdrawn all at once. So for example, your RRSP or your RRIF, you've been taking it out a little bit at a time as you need it throughout the year. Well, instead, if you have $1 million still in that account, that $1 million is treated as though it's withdrawn all at once and taxed as though it's withdrawn all at once as well. So that can have a significant impact on your overall planning and the liquidity of your estate.
Yeah. It's, I just thought of this. It's kind of unfortunate that CRA doesn't allow a gradual reduction in the RSP, like do it over 5 years as opposed to 1 year. But I know that CRA allows some strategies that will maybe defer or limit the amount of taxes. If a person has a spouse, what strategy can come into play?
So if an individual has a surviving spouse or common law partner, there is an ability to defer those taxes to the future by rolling that RRSP or RRIF out to that individual. Now, that individual does have to put that money into their own RRSP or RRIF. So there does have to be a legitimate transfer of those funds from one registered account to that spouse's registered account. And then that individual will pay tax on it over time, as you mentioned, sort of withdrawing a bit at a time and using lower tax brackets. And so that doesn't eliminate the tax, but does reduce the tax potentially by deferring that over a longer period of time when they need it, rather than that lump sum coming in.
Okay. But I guess ultimately, if the person, say the spouse rolls or receives the rollover from the deceased spouse, if those funds continue to grow at a rate faster than the withdrawal rate, CRA will still get their large share of the RSP or registered.
They will. I mean, ultimately, you're allowing that account to continue to grow on a tax deferred basis, and there will be, because it's a deferral, there will be tax paid on it at some point, whether it's on withdrawal over time or in an estate. Right.
Okay. So for the second spouse, if there's a dependent child or grandchild, what can be done in that situation?
So there are situations where you can roll those RSP or RRIF amounts to another qualifying beneficiary who is eligible for a rollover as well. It's somewhat limited. You would be rolling it to perhaps an adult child who is financially dependent upon you. And that financial dependence is sort of guideline measured by what's the personal tax bracket, that first personal tax exemption that you get, or credit rather, that you get of about $13,000. If their income is less than that, they are likely financially dependent upon you. Similarly, if someone is dependent upon you because of a mental or physical infirmity and that they do require some additional support, both now and throughout their lifetime, you do have an ability to roll to individuals that you have been assisting and want to continue to assist as well. And that also defers the tax to when they're starting to take that money out as well. So for an adult adult child, for example, or grandchild that you're moving money out to, you have the option of putting that money into an annuity that they would pull out over time and pay tax over time. You have a bit more flexibility when someone is dependent on you because of a mental or physical infirmity, because you could perhaps take advantage of, their RRSP or RRIF, if that is an option, or also RDSPs, which are often an overlooked vehicle for registered accounts for individuals. There's some limitations on it because there's limitations on how much you can put in. I believe it's around $200,000. There's limitations on the age in which it can be put in, but the executor should explore those options together with the beneficiary to determine what's the most tax effective way to deal with that inheritance.
Okay. If I pass away, and let's say that I'm in my 70s and I'm married, and or I have a spouse, and my spouse is under 71, is there any contribution strategy available to the personal representative upon my death?
There's a little bit in that year that you pass away. So in the year that an individual passes away, if they have some RRSP contribution room available, obviously they can't contribute to their own retirement plan because there's not an ongoing retirement plan need. Yeah. But they do have an opportunity to make a contribution that can be applied to their spouse. So that RRSP is rolling to that spouse. And so that does allow one more opportunity for a deduction. So the personal representative can work together with the financial institution to get a contribution in place within within a relatively short time frame. It needs to be within a certain number of days after the end of the year that the person passed away.
Okay. Does it have to be in a person's will, or is that open to the executor regardless of what might be in the will?
So there are some opportunities. The individual can either directly specify in their will that they would like their RRSP or RIF to roll to a specific individual.
Mm-hmm.
But often you'll find clauses in the will itself that allows the executor or personal representative to deal with things in a tax effective manner, which does open that opportunity to look at what else is available for tax planning for the estate itself. And also they could choose to specifically name the beneficiary of the RRSP or RIF, which would mean it would pass outside of the estate. Mm-hmm. If neither of those things happen, the personal representative and the surviving spouse or the qualifying survivor can jointly apply to Revenue Canada to have that transfer or rollover take place. Okay. And as long as all of that paperwork is filed, CRA is quite amenable to making sure that works.
Okay. In today's world, a lot of people have, they belong to a pension plan, whether it's a defined benefit or defined contribution. Let's say that I have a pension plan, and my pension plan has $300,000 in it. I pass away prior to retiring. Mm-hmm. What are the rules with regard to a pension plan?
They aren't quite as fun from a tax perspective. So you would need to look at your specific contract, and just as an overall statement before we get into it, whenever you have questions about your pension plan, make sure that you're trying to address as many of those as you can personally, because it actually becomes far more difficult for your personal representative or your surviving spouse or beneficiaries to follow up on those same questions. And that's true of everything that you're dealing with. Have those open conversations with your family and know what's available and know what you're entitled to. So that similarly, you're not having your personal representative or your surviving spouse trying to dig through papers going, did they get a payout or did they sign off on that already? So be familiar with your contract. If your contract allows for a lump sum payment to be paid out upon your death, that's not a death benefit, that's an overall payment out of what retirement benefits lump sum would be. Most often that is actually a taxable amount, a benefit or taxable inheritance to the beneficiary. Whereas with the RRSP, that's taxable to the estate. And so you're looking at different places where that tax may end up happening. And so you need to make sure that the beneficiary and the estate in either case are prepared for where that tax would be. With that amount that's coming from a pension, often the tax is withheld. And the individual beneficiary will receive a tax slip that says, I received this income, this much tax was withheld, which may or may not be sufficient depending on what other income they have. So if you are the beneficiary of a plan like that, you should also speak to your own personal advisor to say, do I need to set a little bit more aside for April or not? And they will get credit for both.
Okay, all right. What about a tax-free savings account? I mean, I know it says tax-free, but on a person's death, are there any tax implications at all that a person has to be aware of?
So, excuse me, when an individual passes away holding their tax-free savings account, first consider it's been able to grow on a tax-free basis up until the day that they passed away. Mm-hmm. So the value that it holds on the day that they passed away, there's not a tax implication up till that point in time. So if we have an account that's worth $75,000 on the day that someone passed away, we're dealing with taxes paid up, as it were, because there weren't any taxes on that $75,000. And then we need to determine what happens with it after that. So we have a few options for planning. So they could name their spouse as their successor beneficiary or their designated beneficiary, depending on what province you're in. This is where some of those things will flow through. Some provinces don't allow for a successor beneficiary. But in either case, you're able to typically move that tax-free savings account, that's $75,000 in this example, from the deceased individual's account into the spouse's account, and where it will continue to grow on a tax-free basis. If the individual who passed away was in an excess contribution position, you do still need to tidy that up, but in general, we're able to move that full amount over. If a tax-free savings account is left to an estate or left to someone other than a surviving spouse or common law partner, then the beneficiary who's receiving that will receive a tax slip for what the change in value was from the day the individual passed away to what it was worth when they got it. So, if that $75,000 account had gone up $300 before it was all tidied up, the beneficiary will receive a tax slip for income for $300 in that example.
Okay, so the beneficiary receives a tax slip, not the estate.
If the beneficiary is specifically named, yes.
Was that right? Didn't know that. I always thought that the estate was always responsible for the taxes, regardless of whether there's a named beneficiary or funds go to the estate.
In most cases, you're absolutely correct. That's a bit of a variation from what we would normally see, but there is a position that became yours on that day because you were a directly named beneficiary. And so that account was your account at that point in time.
Wow. Just shows that everybody, regardless of their interest in taxes, need to be aware of the tax situation upon death. Even if they have to set aside a morning to study and get caught up with the current tax law, they really should do something like that, or have their financial advisor do it and then tell them.
Exactly.
But like Christopher Bullock said, death and taxes. You're not going to get out of life alive without both. So, okay, that's interesting. Does it ever make sense not to have the rollover option put into place when we talk about, say, an RSP?
There are instances where it doesn't make sense to do that rollover. I mean, instinctively, deferring that tax makes sense. Let's push that down the road. But we also want to make sure that we're not leaving anything on the table in that last tax return, or we're not adversely impacting the beneficiary either. So we need to look at it a bit from both sides. So if we're looking first at the deceased individual's tax return, do they have losses that haven't been used up yet? Do they have donations that have carried forward from other years, or they've made in this year, or they've made in their will that we're not using all of the tax brackets because we have credits that we could use? Do they have medical expenses that we want to make sure that we use all the credits, or deductions for support payments or childcare? Or we want to make sure that we're using those lower tax brackets rather than moving things ahead to someone who would perhaps pay tax at a higher bracket. So we want to try to balance that out and not leave anything on the table, as it were. Also, if we're looking at the beneficiary, I'm dealing with a situation right now where the beneficiary has already expressed that when they get the spousal rollover amount, that they are going to need to withdraw it in full because of an emergency with housing. That individual is also receiving some benefits as well that will be impacted by what their income is. So we're working together with the individuals who are looking after their benefits to say, well, what else could we do? Could we pay the tax in the estate instead, so that we don't impact what applications and things this person has in already? And their advisors and benefit advisors are very willing to work with us on that. In that case, as much as we're talking about taxes, we also have to make sure that taxes aren't the only reason we're doing things. In some cases, a little bit more tax in one spot actually makes a much bigger impact in other ways.
Right. Okay.
H beneficiaries in Alberta and the equivalent in other provinces as well is another instance where we want to be careful with income and inheritances.
Right. Can you do a partial rollover, or does the full amount of the RSP, for instance, need to be rolled over?
I have never actually done it, but I don't see any reason why you couldn't do a partial rollover, have a partial partial withdrawal and a partial rollover. I can't think of any reason why you wouldn't be able to do that. It's just typically we do see that full move over. It's very rare that I don't see a rollover of those RRSPs. We usually do the planning with other things.
Right. Yeah, that just makes sense.
Mm-hmm.
From the capital property perspective, or the non-registered, what does a person need to know about what's going to happen with their capital property upon their death or immediately before the death?
Mm-hmm. So, as we noted earlier, when you pass away, you're deemed to have disposed of everything that you own. So it's kind of a pretend sale. It's though you had yard saled everything that you have, and now it's all been considered to be sold. And so, quite surprisingly to people, that does include also things that are joint beneficiaries, joint holders, or items that they have passed to someone as a beneficiary. And so we do need to consider that sometimes things pass outside of the estate for legal purposes, but don't for tax purposes. So that is something the personal representative should be aware of when they're doing their planning. So if you have a joint property, for example, half of it is considered to, or whatever portion it is, depending on the ownership, you've considered to have disposed of your portion of that. Your investment accounts that are non-registered, you're considered to have disposed of all of those. But it also includes things like rental properties and sole proprietorship assets. If you're running a farm or a business, we have those assets that are held there if you're running that personally as well. And things that people don't tend to think of as well, jewelry and artwork and book collections and your vehicle as well, although hardly anyone's vehicle ever goes up. But in general, we need to consider how much did you pay for it and how much is it worth now? And the difference between those two is your taxable capital gain or your allowable capital loss, depending on which way that's gone. And so you do end up paying taxes on that increase in value of things. And for the personal representative and for your own planning going forward, making sure that people know how much those things cost is actually a little more difficult. Some things are easy. As long, if you're self-managing your investments, of course, you need to track it. But if you're working with a financial advisor, it's often relatively easy to gather that cost and fair market value information. It becomes a little more difficult with things like real estate, things like those collections and jewelry. Make sure that you're keeping a list of what those things are, just to make it easier for everyone to deal with. And make sure as well that people know the value of what you have also, so that someone's not swooping in and say, I will take this lovely collection for however much. But I find the things that actually surprise people the most are the joint properties, because they think, well, that went outside the estate. Or the items that they're considering to be personal items, like the jewelry and artwork and things like that. That it's actually very difficult to determine how much someone paid for an engagement ring that's now being left to someone 50 years later.
Yeah. What do you do in a case where, with jewelry, if receipts aren't kept or the receipts are lost, so the actual cost isn't known for sure?
So with things like that, there are a few things we need to consider as well with costs. I mean, for cost, we have how much did you pay for it, but then also considerations of when things changed in the Tax Act, because up until 1972, we didn't have capital gains. And in 1994, there was an ability to do an election to bump up the value of some items, or things like real estate or property where you made some significant additions, or you changed the roof, or you put in a dock, or make sure you're tracking what all of those things are, so you come to something that's called an adjusted cost base. But if you do have things that you simply are trying to figure out what the value is, we often reach out to professionals in that area. So we would reach out to a jeweler, and the example of jewelry, and say, how much would this have been worth, at points in time? so that we can get an idea of what we think that cost would be. What was its value at the point when capital gains became a thing in Canada, in Canadian taxes? And what do you think it's worth now? And some things are very cyclical in value because they're fashion driven as well, like jewelry. Things like real estate will reach out to a realtor or evaluator and say, what do you think this would have been worth at this point in time? Sometimes you're able to pull land titles or other documents, but personal property is one of the toughest things to try to come up with values for.
Yeah, no doubt. So if there's a spouse involved or existing rather, what options are available to the personal representative to try and defer taxes?
So in the same way that we're able to roll those registered accounts that we were talking about earlier, that default of disposing of everything at fair market value actually allows for a spousal rollover to a spouse or common law partner. So things are passed on to that individual at cost. So taxes aren't paid now, unless we choose to. And so they go to that individual, whatever that is, at cost, and tax is deferred until either that individual disposes of them or they're dealt with in that individual's estate in the future. As far as that reduction in tax, and I just mentioned unless we choose to pay tax, similarly to how we commented earlier, we don't want to leave things on the table. So if we're not using the lower tax brackets, if we're not using losses, if we're not using the credits, we may elect to actually transfer some of those things at fair market value instead of cost in order to use those things out.
Okay. And earlier you mentioned about losses. So how do previous year's losses come into play, or how can they be used?
So if you have losses from previous years that, or in the current year, that you are not able to use, you're just everything that sort of flows through, particularly capital losses, because capital losses can only be used against capital gains. So we're quite limited in what we're able to use them against. So if we don't have capital gains to use those capital losses against, then we have the opportunity, once we've looked at, do we need them this year? As in any tax year, we could look to say, could we carry them back for 3 years? If we still don't need them to carry back to recover taxes from other returns, in the year that someone passes away, those capital losses can be used against any kind of income.
But the next question was, can those capital losses, if you can't use them, can they be transferred to the spouse?
Unfortunately, they can't. No.
But at least they can be used against any income.
They can be used against any income. And that's where we're sort of looking at, do we roll everything at cost or not? Because why not bump up that cost base for the surviving spouse and use up those losses on that return?
Yeah.
And so rather than moving an investment portfolio over at cost, you can move a portion of it over at fair market value. And in the instance of anything, but an investment portfolio is quite often where we do a lot of that planning. It's on a share by share basis. So if we only need X number of dollars, we only need to transfer that portion at fair market value.
Right. Okay. You also mentioned earlier about joint property, and I think a lot of people don't realize that even though the property may be joint, there's still a tax implication if it's non-registered. How does CRA find out that something like joint property, the gain on the joint property wasn't included in a terminal return? If the personal representative made a mistake, how does CRA find out these things?
Well, CRA doesn't share their secrets on how they find those things out. But if you apply sort of a logic to it of if I were a CRA auditor, what would I maybe do to see whether or not everything was included? I would think that a really easy way for joint property is for there to be a project on land titles. land titles have people's names on them. And so do bank accounts. Those slips come in, that say that they're joint accounts or say that they're individual accounts. And CRA already has record of those, for example. So, and they, as I say, they don't share their secrets, but I think that would be a quite easy way for them to follow up on where things are, and how things flow through.
And on just regular bank accounts, where the account was just in the mother's name, for instance, and the daughter, who's the executor, adds her name. There's usually no gain on or very little interest on bank accounts, right? Nowadays, anyway. So
that's true. One thing that we do advise our clients to make sure that they're tracking is make sure they track what their intention is. So you're right. Quite often, mom or dad or grandma or grandpa is perhaps not as able to get around, or is in a nursing care, or the world has become more far-flung. Perhaps you don't live in the same community anymore. And so for convenience, so that someone can help out a family member with their banking, the name gets added to a bank account to make it easier to pay bills. Or their name gets added to title of a piece of property for estate purposes, but not necessarily intending this to be a gift right now. So we want to make sure that we tell our clients to really clearly define what they want that to be. So if you've actually intended to gift something to someone now, like give them half of the property in an instance where we have two owners, then there is a disposition in that year because you've gifted it. But if you've put someone's name on to make things easier for your estate or to make things easier for your day-to-day affairs, and you actually intend that to be part of your estate, you should make sure that you've talked to your lawyer about how you make sure that says that somewhere, so that is part of your estate. It does flow through. Money makes people do funny things. So just make sure that you have in either case, because maybe you do intend for someone who's been helping you out a lot to be the recipient of that account, not your estate. Or maybe you don't. Maybe you intend it to be part of your estate that's divided amongst all four of your children or however many there are. But make sure you write things down. If they're not written down, when someone's dealing with your estate, they kind of don't exist.
Yeah. And, just the amount that could be owing in taxes when the second spouse passes away. You see where life insurance could play a major part in funding that tax bill.
It can. But you also need to be careful of where you're putting that life insurance if you're wanting that to occur. Right. So if you name your life insurance policy your estate as a beneficiary of your life insurance policy, that money is readily available for the payment of your taxes, and it's a great way to plan for that. It's very useful to sit down with your advisors and say, well, what would happen if both my spouse and I passed away tomorrow in a car accident and we had no opportunity to plan, no opportunity to defer? Is my estate in a position that they could pay that tax? Is there liquidity or something that could easily be sold? Or am I tied up in land and real estate and things that I don't necessarily want to have sold? Or my beneficiaries may not want to necessarily have sold. And so that life insurance fills that spot of being able to pay those taxes. If you name someone else as beneficiary of your life insurance policy, that's great because it's getting money into their hands quite quickly. Sometimes bank accounts are frozen during the probate process. You want to make sure your family has funds readily available for day-to-day living, but that actually means that money is theirs. It's not necessarily money that they need to use to pay the taxes. So you need to balance out sort of where all of that's going to go and what you want your insurance to be used for. And your personal representative also should speak to an advisor early in the process. As we talked about, there's an estate now that the property is owned by. We want that estate to have a particular kind of status under the Income Tax Act called a graduated rate estate. Lots of fun rules about that, but most important for the personal representative is it has tax brackets that are graduated like it's a person. So it pays tax at X amount up to 25,000 and this amount up to 50 and so on. It can have a non-calendar year end, and we have some ability to plan with donations that were made in the will and planning when they own private corporation shares. So we have, and perhaps losses that we could carry back. So we have more opportunities to do additional tax planning if it's a graduated rate estate. In order to be a graduated rate estate, it also needs to remain independent. So the beneficiaries can't pay the tax of the estate. And so make sure if you are an executor or a personal representative of an estate that you meet with an advisor early in the process to make sure you don't taint that graduated rate estate status, that you deal with things in the right order and you access funds from the right place so that you leave the most opportunity available to you to plan.
Okay. Oh, a lot to go into it. A lot
there
to
is.
I guess, the more complicated the estate or the person, the deceased financial life, the more important it is to get advice from somebody like yourself who will point the personal representative in the right direction.
Exactly. You don't want to discover that you've done something that has limited what planning opportunities that you have.
Yeah. When there's a private corporation, so let's say that I own my own company, and either I'm a sole shareholder or maybe there's 4 of us. How do you value the shares immediately prior to the person's death when it's a private company?
And so there are a few ways to do it. If you have a shareholders agreement in place, which defines how that's going to be dealt with, that's perfect. And so we do encourage people to put those agreements in place when everyone's getting along and everyone can agree to what that might be. And so that value might be determined to be a multiplier of sales, or a percentage of the assets owned, or whatever that company deems to be fair, and those shareholders deem to be fair. In other instances, you may need to get your company valued by a professional valuator, where they will look at how much is this building worth, how much, what do we expect the ongoing profits and sales of this company to be. So it can become quite complex to value it. Some companies are easier. Maybe you've reached a point where your company only holds investments now because you've retired and that's what's sitting in there. Those are a little easier to value because it's a fair market value report. But typically we would advise people to either rely on documents that are in place that defines that, or get a valuation done.
Okay. Again, that goes back to planning, right? Always thinking about what might happen in the future and helping your personal representative and your loved ones in the situation that you do pass away.
The ownership of a private corporation also adds some complexity to that overall planning, because if that planning is not done correctly, when you own shares of a private corporation, you could end up paying tax twice on the same thing, because we have that deemed disposition on that personal tax return that we've discussed already.
Yeah.
So now the estate owns shares of this company. The way that you get value out of the company is to pay dividends. And so we have a capital gain in our terminal tax return, and we have dividends in our estate in order to pull that value out of the company. And so there is planning that needs to be done with advisors within the first taxation year so that you can make some choices about what you're going to do in order to reduce or eliminate one of those layers of tax so that you end up with a basis that is more fair, for lack of a better way to put it.
So, well, I see why not just anybody's an accountant, right? I mean, you've obviously taken a lot of courses in tax and estate planning in order to gain the knowledge that you have. It's a credit to you and your field, your profession. Now we don't have time today to talk about depreciation, like depreciable capital assets, but I would think that they probably add another layer of complexity to a person's terminal return.
They can.
What about the personal exemption on a house, on a residence. So that's pretty straightforward if a person only owns their home. But what if they have a vacation property or a rental property? How can the person determine which property should have the personal residential exemption?
And so principal residences have definitely been a tax point lately as well, like in our most recent budget and sort of going forward on ownership and things as well. So it's a bit of a hot topic. And also it's been relatively recent in 2017 when you had to start actually designating your principal residence on the sale as well, in order to make sure there's not host flipping and make sure that everything's being dealt with appropriately. So you don't actually have to designate a property until you've actually sold it, or until there's been a change of use, or in your estate. So when you have that deemed disposition, when there's a change of use, we have a deemed disposition as well. So in instances where, like you said, someone owns a house and a vacation property, we look at when did you own them, because you can only designate one of those properties in any year as your principal residence. Then we look at which property went up more in value, is we want to protect as much capital gain as possible. So in order for your property to be considered your principal residence, it doesn't have to be in Canada. It can be outside of Canada, but it needs to be a property that you do own and needs to be a property that you ordinarily inhabit. And ordinarily inhabit isn't defined. So if it's a property you use regularly for vacation and you're there on a somewhat regular basis, you should be able to claim that as your principal residence, and that gain on that property, you see it sort of come into your tax return as a capital gain, and then you see your principal residence exemption to take it back out of your return. Okay. It is important whether you're doing planning for your own tax returns now or in an estate that you do fill out that designation form, as the penalty to not fill out that designation form is significant.
Good to know then. You mentioned foreign property. I was going to ask you, if somebody owns a property, say in Canada, and then somewhere in Alberta, and they have a vacation property in, say, Mexico, and they pass away, what are the tax implications when a deceased person owns property outside of Canada?
So from a legal perspective, make sure that you've dealt with whether or not you need to do probate in both places and deal with, and so you deal with your lawyer on that. From a tax perspective, in Canada, you report based on everything that you own based on your residency in Canada. And so the personal representative would need to gather the information on that Mexican property in this example and say, well, when did they purchase it? And how much did they pay for it? And what was the foreign exchange rate at that time? What did they pay for it in Canadian dollars? And then we would look at what is it worth now in Canadian dollars. And so you may have a gain or a loss on the property itself, and you may also have a gain or loss in the foreign exchange rate also. And so there are instances where, depending on how the numbers work, you might have a loss on the property, but a gain on the foreign exchange. It's quite often people are like, well, no, I sold it for less than I paid for it. But when you incorporate that foreign exchange, it may not be the case. So you do need to consider that when you're determining the capital gain as well, or loss.
Yeah, I was going to say, I bet you a lot of people forget about or aren't aware of the foreign exchange. They may calculate what the Canadian value is, but they forget about the foreign exchange gain or loss. They're not aware of it. So is there like tax treaties? So let's say that I do own property in Mexico. Would my estate pay tax to the Mexican government and to the Canadian government, or how does that work?
I'm not familiar with what treaty provisions we have with Mexico specifically, but Generally, globally, there are treaties in place with many countries to avoid having to pay tax twice. And so though you would need to look at the treaty for the specific country and say, well, what treaty do we have with that country? Where does the tax get paid first? And where does the credit come from? And look at what the treaty is for that specific country.
Okay, so when that comes, let's say my property is in the States. So my estate would pay tax to the U.S. government,
Mm-hmm.
but then I would get a credit on terminal tax return that I wouldn't. So U.S. government gets their money, the Canadian government doesn't.
Yeah, so you get credit for the amount of tax that you've paid elsewhere.
Okay, all right, that's kind of interesting. What about where the deceased is in Alberta and the executor or personal representative is in another jurisdiction in the province? Does that pose any issue?
So if you have a named, if you've named your personal representative and they live in a different province in Canada, we don't have any issues from a Canadian tax perspective of where we're dealing with things. What we do have to consider is when probate is applied for, it's possible that the personal representative might have to pay a bond. So they should talk to the lawyer about how that would all work out. Okay. But from a tax perspective, we have the individual who passed away in Alberta, and that tax return is filed for a resident of Alberta. And now if their personal representative, for example, lives in Manitoba, the estate, and they do make all of the decisions and do all of the planning and all of the dealing with the estate from Manitoba, the estate is actually resident in Manitoba because that's where it's being managed and where decisions are being made. Now, that's a quite general impact of it. That would be sort of your starting point, because it is very much a question of fact of where something is resident. Where we have had instances where, in that same example of Alberta versus Manitoba, where the personal representative specifically did fly back to Alberta to deal with things. And so we did take a position that actually was resident in Alberta. She came back here to deal with the business that was here and helped run that business until it was able to be sold. But in general, it's going to be resident where the person who's managing it is.
Really? I did not know that.
That becomes quite a complicating factor if perhaps you've named your son or daughter as your executor and they've moved to the US.
Yeah.
And so now we potentially have a US estate versus a Canadian estate. So you may want to talk to your lawyer and your advisors about what impact that may have. And so you may want to consider including clauses in your will that says, if my named representative leaves Canada, then they would be replaced by this person. You would have to decide in your own situation and your own trusted advisors and trusted people how that sort of flows out. But you'll want to make sure that as you're planning your own estate, you're aware what impacts that might have.
Okay, this is maybe a bit off topic, but MNP is worldwide. You're down in the States?
MNP is a Canadian company, but we do have referral sources where we can refer people to accounting firms in other countries. But MNP itself is a Canadian company.
Yeah, I was going to ask if MNP was in the States and I lived in Wisconsin and I was the executor, whether I could go through MNP in the States or whether I would have to contact the Canadian version. But I guess you just answered that question.
Yeah. Like within Canada, it's no problem to work our way across. Our offices are all interconnected and we're all the way across Canada now. Mm-hmm. We also do have individuals within our firm who are international tax focused or US tax focused. So in that example, we do have individuals here in Canada who could assist with filings. But if there was an issue that it was most appropriate for someone in that domestic jurisdiction to deal with, we are part of a worldwide network that provides a referral source that we can give some names to our clients of, here's some people that you can reach out to and interview and see if they're the right match for you.
Okay. And then one final question. In order to get the clearance certificate, I think it's called, what all has to be done? Like, before CRA issues it, what all has to be done?
So a clearance certificate from Revenue Canada kind of ties things off and says that we're done. So all of the tax returns need to be filed. So we were mentioning at our first question at the beginning, you have to make sure you caught up previous tax returns if the individual hasn't filed them. So all of the returns have to be filed, all the taxes need to be paid, and all of the returns need to be assessed. There can't be any outstanding notices of objection or outstanding requests for interest and penalty relief. So everything has to be finished from your perspective. And then you would file for a clearance certificate from Revenue Canada. That clearance certificate can be filed all at once or in stages. You can file for a clearance certificate up to the date of death, for a partial distribution of an estate, and for a final distribution of an estate. Just as a caveat, just because some of the people who are doing this may not have been executors before, when we're applying for a clearance certificate for the final distribution, that doesn't mean you've actually given everything out yet. You as a personal representative should be, holding a portion back in case something comes up. So you want what you have left in the estate to be in a situation where we're not earning any more income in the estate either, that there's not going to be a requirement for an additional tax return for the estate. So we file for that request from Revenue Canada. They send a document back that says, it's a one-pager that just has a signature on the bottom that says you have a clearance certificate. That provides the personal representative from personal liability if CRA came back and assessed taxes in the future. And so when you receive, as a personal representative, you receive that document, you can then distribute the remainder of the estate. And if in the odd situation CRA came back and said there were future taxes, they would not be your personal responsibility as executor or personal representative.
Okay, it looks like we're just about out of time. Thank you again, Michelle, for being our guest today. Your insight and your value were excellent. I really appreciate your input and your knowledge. As I said earlier, you're obviously very knowledgeable in tax and estate planning. So I think you represent MNP very well.
Thank you. I appreciate it.
Well, you're welcome. Michelle, how can our audience get in touch with you?
So they can get in touch with myself or other individuals at MNP, most directly through our website, mmp.ca. And you can do a search for me individually. It's Michelle D. Coleman. Or you can send me an email at michelle.coleman@mmp.ca, and I can get back to you.
Okay, great. Well, thank you very much. And thank you once more to our sponsor, Customplan Financial Advisors. Customplan Financial Advisors is an award-winning MGA that provides excellent resources and support for the independent financial advisor. Please visit their website at customplanfinancial.com. This podcast is available on Spotify, YouTube, and at financialpodcast.ca. To be notified of when new podcasts are available, please subscribe by visiting financialpodcast.ca. If you have a topic or an idea that you would like to submit for a podcast, please do so by contacting us at contact@financialpodcast.ca or info@financialpodcast.ca. And we would love to receive your feedback as well. Thank you again, Michelle. And to everybody else, have a fabulous day.
The views expressed here are those of the participants and not those of Customplan Financial Advisors, Inc., its affiliates, or subsidiaries. This is not intended to serve as a complete analysis of every material fact regarding any company, industry, or security. This presentation may contain forward-looking statements. Investors are cautioned not to place undue reliance on such statements, as actual results could vary. This site and podcasts are for general information purposes only and does not constitute investment advice and is not intended as an endorsement of any specific investment product or service. Individual investors should consult with an investment professional about their personal situation. Past performance is not indicative of future results. If you are unsure about what is the best course of action for you in your financial planning, then we suggest you consult a fee-based independent financial advisor or get in touch with us to discuss your individual situation. Our phone number is 604-687-7773.